With me now is Vikram Kotak of Crest Capital. He has about 21 years of experience in the market and has always looked for fund management and how to find ideas for his investors, and whom I personally know is very, very passionate about finding new ideas, finding new growth businesses, and he joins us now on this auspicious occasion of Diwali. Firstly, Vikram, to you and your team, a very, very happy Diwali. Hope you'll have a great 2016-17.
Happy Diwali to you and all the team members at NDTV, and also all your viewers. Have a successful and very, very good Diwali.
Right. So Vikram, last year back, say if we would have chatted at this time, of course Indian markets were doing well. But this year, something seems to have changed. Every decline is getting bought. What, according to you, has changed in the last 12-24 months?
I think a few things fundamentally have changed. One, clearly when you look at the global scenario, you have the sluggish global world where there's a growth is a shortage. You see oil prices, commodity prices are stable at a particular level, particular range, which is also helping Indian markets to do better. On local side, you have 3 or 4 things which is doing right. One is the interest rates are coming down, which is ultimately transmitting into the corporate sector borrowing, and you will ultimately see yields coming down. Second, most important, is the government policy momentum. The policy reforms has been at its best in a decade, which is also helping to some extent. A lot of corporate policy to be made. Like, I'll give the example of public capex. There's a good start of public capex in the oil and gas sector, railways, you can see on road side, which is also helping a lot of corporates to come back in the capex line. That's a point number 2. Point number 3, you have a very, very good monsoon this year, right? After 2 years of drought, you have suddenly a very good year of monsoon, which is, in my view, along with 7-pay commission and 1-rank pension, you'll see a lot of money which is going to travel into the consumer sector. So you have so many things suddenly coming, and what India was waiting for a long time, I think it's all coming together in a basket, and which is going to, help earning momentum to come back, which has been sluggish for last almost 14-15 quarters. I think the next 8 to 10 quarters, we'll see a very, very good earning growth which is coming in. Our estimate is FY18, we may see a 20 to 22% earning growth, which is what I think market is trying to price in and trying to kind of put into the index right now.
So Vikram, you just mentioned that 20% earnings growth is something that you're looking at. Now, we have been interviewing a lot of sell-side strategists who make these earnings estimates, and everybody is of the view that 15, 16, 14% would be a good number. Have people forgotten that India can grow at 20%?
I think it's not about forget. It's about I think we've seen a lot of delay in what India was reserving for a long period of time. Your earnings has been delayed, your capex has been delayed, your global uncertainty has delayed to some extent. Even the reforms, a lot of people are kind of hoping that 2014 will start with a big bang reform, but government took its time. Clear the fundamental side of it, come to the root level, and then they started kind of putting the policy reforms. So I think all these things are now coming together. And I believe if you look at the commodity prices, which is helping the input costs, or you look at interest costs, like I'll give you an example of 110 basis point down in 10-year bond in India in last 13 months. Now the 110 basis point is going to somewhere go and transmit to the corporate sector, going to help earning, going to boost the consumer. You have good monsoon, you have 7-pay commission, you have the global oil price, which is just kind of hovering in that 40-60 band. All these benefits are ultimately going to play into the earnings. And now you have the capex which is starting, public capex, which is also going to kind of drive the momentum. So now you have all back-ended growth, which has been kind of pent up, is now going to play out in FY18 and FY19.
A lot of people are also saying that, it's just the base effect that is happening. But as an investor, do you really care about base effect, or it's already in the numbers?
I think base effect is known to the world. But point is that can you bring this 20% growth for a year or a 3-year? I'm of the opinion that we'll see this 20% growth going to remain for FY18, 19 and 20. So then you can't talk about base effect. Base effect can be FY18 alone. But what about FY19 and 20? So I think that momentum pickup will drive going forward, which is going to be more sustainable, which is what our theme is.
So say if you were in 2004, when you were looking at a similar sort of a picture for 2005 to 8, that time India was not a discovered market. But this time, with valuations, the sort of FII holding that we have, it will be a little different.
Yeah. See, 2004, India was in a very different situation where the globe also was growing. So there was never a shortage of growth. You had all the market. European was doing well. China was doing extremely well. So you had a lot of growth opportunity. Brazil, Russia was booming with the oil sector doing well and commodities doing well. Today, fortunately for India, there are how many countries globally right now growing at 7%? You'll find 5 or 6 of the total. And some of the companies you can't invest, you can't invest because they are less than $1 trillion size, they are very liquid market. So something which is a $2 trillion economy and with $1.6 trillion market cap, there are very few countries in the world. So you have, this is the advantage to India this time. Second, I think most important is the government. I think government is creating a good noise. They've kind of done a good job. You see this, that is flowing in the FDI flows right now in the country. You see decade best fiscal deficit and current account deficit. So I think all these things combined, you have the climate or the situation or platform for India is much solid, particularly when the globe is in a real problem. Okay, people used to say, I remember, that Europe is a risk-free. Okay, today people are saying Europe is a risky. India was in 2004 was risky. Now people are saying risk-free. So so-called or perceived risk-free money is coming to risky market.
Right. You're one of the different investors who looks at fixed income very closely. With bonds globally being as good as zero, how do you do valuations? I mean, the PE, I mean, there should actually be no PE. So how do you look at valuations now?
So that's why you're seeing this, for a 20% earning growth, market is ready to price or give a higher PE multiple to the company because they're looking at that consistency of earning, which will give them some kind of positive earning. Otherwise, earnings are zero, as you rightly said. And when you talk to global investors and when we see India yield today, even despite its 675, 80, it's a great yield. When you have currency which is more stable. Why currency is stable, which a fiscal deficit is better, current account is much superior. So today your currency is one of the best performing. So when investors want to put money in India, a 10-year India sovereign bond, which is 675, you have currency which is stable, so your normal returns are 675. So that's a great return in the world which is at zero or negative interest rates. So summary is that if you grow this earnings at 18-20%, the multiple which India is getting today of 18-19, 1 year forward 17-18 or so, I think this will going to remain same or maybe actually can re-rate further depending on the global situation.
Right. So, last year we spoke to you and we spoke to you extensively, and one of the key takeaways probably 18 months back was that airline as a sector is doing very well.
Yeah.
Now, is that a consumption sort of a story? Would you not look at traditional names like HL? I know you cannot talk about stocks, but would you not look at the traditional names and probably look at tourism, airlines, how they are growing? Is that a new consumption play?
It is very clear. I think what you look in India today is what consumer want or where is the penetration story left out. When you see India's penetration in airline is one of the lowest in the world. You look at consumer durable, we talked about that last year. Consumer durable, you pick up anything, air conditioner, washing machine, TV, India is still less than 10%. So that gap has to fill up. How do you fill this gap? When your income levels are going up. When your rural money is coming back now in the system, your urban growth is going to be there. You have 7-pay which is coming to the government employees. Now all these things will combine, explode this kind of growth. And in airline particularly, rightly said, it's a change in the consumer habit. So once you travel by airline, when you see an airline and a railway fare of the like-to-like comparison of first AC versus airline looks much better because you save your time. And today India, I think everyone needs people know value of time. When you have the same fare, people will start flying into the airline, and once you fly into the airline, you don't want to change your habit. So once you upgrade yourself to the airline, people want to again travel. So I think that change in consumer habit is the biggest driver for airline, whether your oil remains at 50 or 60 or 65, it's going to change dramatically airline industry's earnings number because they can actually pass on. Because once you have the more and more consumer coming to you.
Right. So, we have new airlines like Vistara, a lot of other new airlines coming up. Does that worry you, say, like a big player, Indigo, will lose market share?
But the penetration, see, I remember Maruti's case when Hyundai came and Ford came and everything, and people worried about the losing market share, or maybe insurance. A typical example of my own industry where I worked. When LIC used to enjoy 100%, when all these private guys came, definitely LIC has to lose its share. But what is LIC's size in 2001 when the insurance started and today? It's all grown. Right? Same for Maruti. Maruti was selling X vehicle, today they're selling 5X vehicle despite of the half market share. So same thing will happen maybe to the lead players, but ultimately the growth of the market is going to be so good. I think the airline industry can sustainably over the next 10 years can grow at 10 to 12%. And that's a big number for the industry. So I think there's a huge amount of opportunity in the aviation.
Will oil marketing also now classify as a consumption play?
You can say so because you have the government has removed the subsidy part of it. So you have a straight facing consumer face where you can actually pass on the hike or reduction. So actually in a way it's a very, very well decontrolled industry which is actually showing you the exact earning translation which is happening because of the global oil price into the balance sheet, which is a correct thing to do.
So say probably 1 year down the line when their debt issues are behind, they start to pay back their debt over 2 years. Their multiples can re-rate even further after 3 to 4 years?
It may not re-rate as much as the pure consumer play, but yeah, once you start showing that ROE, once you start showing that debt repayment, the cash flows are coming in, I think you will see some kind of upgrade there also.
Right. Let's talk about corporate banks because they have been the theme in the last 2 weeks or so. Big groups like SR, Jaiprakash Associates, they have come down big, done big deleveraging. Arcom has done big deleveraging. You think that is very, very beneficiary for corporate banks?
Yeah, it's happening. I think that a good thing about that the companies are coming and seeing, and they are. I remember 2 years back when this deleveraging topic came, I'd seen a lot of promoters were holding back. They're saying it's so bad valuation. I want a double of this, or I want 1.5 times of this. But today, I think there's a crisis situation for many of the corporates, and they realize that. And those who are able to deleverage, they're able to sustain and survive. And that's what we are seeing in some point of time, which will ultimately benefit the banks because the NPAs have been all kind of booked in their book. So that can be a recovery can be seen in that level. But I'm more excited, Pankaj, about the NBFC because you can see this yield change which is happening in 10-year bond, which is straight again benefit to the NBFC because they all borrow in the markets. I'm talking about AAA and AA NBFC. They will see a huge amount of cost benefit. I think 100 basis point cost reduction in last 1 year in their balance sheet, which they'll pass on maybe half of it. That half of it will add into the bottom line. So I think NBFC, both on a housing finance or on the urban facing NBFC, auto finance, even a microfinance, I think all these sectors are looking good, which I'm bullish for last 1 year or so.
So, if I just look at, the three sectors that you mentioned within NBFC, let's start with microfinance. Very high valuation, very high growth. How would you look at the sector?
I think the sector provides a tremendous opportunity because you look at the unbanked sector in the country. I think despite all this microfinance combined, we are not even reached at a 5% of the total lending. So that unbanked area is so huge. Indians, totally we have 33% people only having the bank account. Rest of them, they don't have bank account. So still the penetration opportunity is huge. And I think that the growth will remain for a long period of time.
Right. And for housing finance companies, despite real estate market being slow, aren't you worried that, growth may slow down?
Growth will slow down, definitely. It will not be a 25% kind of growth, but opportunity is huge because, again, the same thing that you have 7-pay, you have rural, you have people want to even forget about buying a new house. People want to rebuild their house. People want to change from their old typical house to a bigger house. So you'll see that kind of opportunity also coming to them. So rural is a big opportunity. You have the urban, along with the 7-pay. And along with the urban consumption is slowly coming back. I think there's opportunity in the housing finance sector also.
Right. Also, let's talk about the auto and the two-wheeler pack that you just mentioned in terms of NBFCs. Firstly, your view on auto and auto ancillary, you think they will do well, which in turn will lead to better, demand for this NBFCs?
I think auto has a big opportunity in India, despite the same penetration story. Now, what kind of stocks you are buying, what kind of selection you are doing, that's very crucial. Second, very important, auto ancillary, I have a mixed view. I'm very contrarian view here because globally things are changing. Globally, it's not typical auto ancillary company which is supplying to Ford or GM will do the same thing because you have Tesla kind of new animal which is really kind of taking the market big way. So when you have electric vehicle market coming in, you'll see a lot of change in the auto end sector which is exporting from India. So I think over the next 5 years, we have to really see this sector. We can't be over bullish on this sector despite of the very good run. And I was bullish 2 years back on auto ink. But now with the changing paradigm in the people moving from the regular car to the electric car, which can also charge your house with the same battery, I think you'll see a lot of change in that sector. So you have to really carefully see that which sector, which company will be not impacted. But I think most of the companies in auto can have some impact.
Right. And particularly on auto, two-wheelers, four-wheelers, you seem to be bullish despite competition, new launches.
Clearly a car, four-wheeler passenger is the best footed in the whole segment. That's my view. I think so. Continue to like four-wheeler passenger vehicles.
Right. Most of the people have been taking loans for four-wheelers, two-wheelers, not from NBFCs, but probably from banks. But it has changed. It has changed over a period of last 3-4 years. You think the share of NBFCs will keep increasing into this area?
It is increasing because of 3 reasons. They are more reachable. They are able to reach to places where banks are not able to reach. And third, it is giving a lot of ease of comfort compared to the regulation in the banking sector to the NBFC sector. So I think there is opportunity there where they are more flexible, they are more agile compared to the PSU banks. And that share they are taking away to the NBFC. I think that opportunity is still alive. Yeah.
Right.
It's a huge market. See, ultimately, Pankaj, it's a huge market everywhere. Now, it's one who reaches fast, one who gives the same convenience to someone who gives the same comfort and the client servicing. I think they'll be able to win the market share.
Right. You're also bullish on infrastructure SPAC as well as oil capex. So first, let's start with infrastructure. Infrastructure is a big sector. You can play it via ports, roads, railways. What within infrastructure you think can do well?
See, one thing clearly coming out is if you look at WPI and CPI, both numbers, there's a huge amount of convergence happening in WPI. WPI is coming very near to CPI. The peak gap was 9% between WPI and CPI. Today is 1.5%. It shows the industrial activity or on a this side of WPI wholesale is picking up. That's the one. Second, India has went through the big slowdown in the capex cycle for last 5-6 years. We've not seen a serious capex coming up. Now, I'm not expecting the capex will run away from here. The private will come and really do the capex. No, that's not the answer. The answer is that the government is pushing the capex. So you'll see public capex, which is going to first take over the whole capex cycle, where you are seeing a lot of momentum right now already in railways, in my view, seeing roads and oil and gas. Why oil and gas? Because there's a lot of money made by the oil and gas companies, and they want to expand their refining capacities and their upstream capacities. So by which you will see oil and gas capex also doing well. So this three sector, I'm expecting a big amount of capex going to happen, not all across the infrastructure, and that will drive the momentum. Okay, that will start picking up, and then you have ancillary capex happening within the capex. So you have oil and gas, but the company will also subcontract to someone else. So you'll have ancillary capex which is going to, so it's a multiplier effect. So we see these three sectors will drive the capex to start with. Then you always have addition of power, and you'll have addition of ports and things coming up. But I think this three sector, I'm very bullish on the capex cycle particularly.
Right. So, for our viewers who are trying to do their research on these sectors, can you just say, because it's a very vast sector, would you look at, strong balance sheets? Just taking an example of NBCC, would you look at asset-light models within this sector?
I think clearly it's a time of great companies. It's not a time of companies we are over leveraged, where the promoters are greedy that they don't want to sell the assets. It's clearly a time for someone who is able to manage the balance sheets and cash flow very well. So whether you pick up the capex or you pick up the consumer durable or aviation, you have to really look at the strong balance sheet which can fund the growth which is going to come in their balance sheet. So I think and should be a prudent company. So I think net summary is that you can't buy a company which is struggling with the ARCs or struggling with the over debt situation. So to buy a strong companies which can manage the next era of the growth.
Right. And because, in infrastructure and capex, we've seen people, making a lot of mistakes. What are the certain ratios, certain things that you would be looking at which our consumers can just, which our viewers can just track on a daily basis or a quarterly basis?
And clearly, there are three important factors which I see when I would look at infra company. I think management and the execution capability of management. And how do you bring the execution capability? One is you should have a right mix of the machinery which you have, and second is you should have a right mix of debt. Because if you're overburdened, then you can't execute. So that's a very second important point of thing. Third is that you are not overstretching yourself in terms of you're making money and then you're reinvesting. So I think that three factors. So ultimately, passing on some benefit by way of dividend payout or creating a reserves in your balance sheet. So you should have a strong balance sheet. Second, your execution, and first, most important is the management quality. That the management has survived all the bad cycles. They are there right now. Their interest is aligned to the shareholders, minority shareholders' interest. This is a very important point.
Right. 2 years back, I remember talking to you where you said that you would be extremely bullish on the small cap space versus the large cap space, and it has done pretty well in 2 years. Now, would it be prudent to put your portfolio towards the large cap space? Would that be a cautious strategy?
I think if you have 3 to 6 months view, maybe you're right. That I will, if someone is talking about 3 to 6 months, a large cap may outperform the small cap, because small cap, in my view, has run beyond as speed for 3 to 6 months. Because you might have, we are right now pricing 18, 19 times. We have on our head a lot of state elections. You have the US results. You have some volatility going to come play, going to hurt you. And then small cap can fall faster. But if you have 3 to 5 year view, then my view remains the same, that you have to keep on buying small and mid cap where you have high quality companies and which are going to grow, which are scalable models. You should invest there. But if you have 3 to 5 year view, if you have 3 to 6 months view, then I think the large cap may outperform, because small cap actually run much faster than the earnings, which is going to demonstrate in coming quarters or coming years.
Right. So till now, we've only got a sector, auto, which has always done well from you, and all others are new sectors or new spaces. But let's talk about IT. Most of the IT companies has declared numbers. Do you think the earning mix itself will change for that 20% growth to come in? IT, pharma, which has always been growing YOY, may not grow so fast?
It's difficult to predict the FTA move, and it can hurt anyone. It can hurt the most blue chip company in the pharma. It can hurt a small company in the pharma. And again, you have to see the policy environment around the world, because for pharma, I think it's very important to see what kind of broad election results are going to play out, what kind of policy the new government is going to play. If you have continuity, then you might see the same thing happening. Opportunity-wise, pharma is a great opportunity, but I think again price to perfection, that you are pricing everything good in the pharma. So you have one shock and you see this, why you see stock going down by 10-15% in a day when you get 1483 or one observation. So I think it's a price to perfection. That's my worry in the pharma. Otherwise, pharma is a great sector. Healthcare opportunity is going to be huge. Arbitrage between the India and the developed world is still very good. But I think I'll remain underweight on the sector. IT, I think the biggest challenge is the growth in the world. Second, the financial sector globally is actually kind of coming down. Okay, so financial sector previously used to do thousands of activity. The regulator has put down, and they are now going to focus on banking. So I think a lot of discretionary spend by these financial entities or banks or financial services is coming down. A lot of manufacturing corporates globally on the US and European side has been cutting down their discretionary spend. So I think that will have impact on the IT sector for some time. And your wage inflation is actually kind of always ticking up. So I'm a little worried about the IT and the pharma as the pack, and telecom also. These are the three sectors which I don't like for almost now 1 year. But my focus will remain on the consumer durables. I think something which is inward looking, which is consumption. So consumer durable, discretionary, something to do with the rate sensitive, which we talk about NBFC and the private banks. And also you have the aviation, which is now the next consumer proxy.
Right. I'll just come back to these sectors, but I just wanted to understand as an investor or, as a person who keeps looking at stock, how would you look at, IT in terms of valuation? Because, they don't have debt. They are still cash flow generating. At what valuations would they really become cheap?
No, they are not expensive. I'm not trying to say they're expensive, but the whole point is that will you get that growth or not? Or do you want to buy a defensive one?
So there may be a structural issue.
The one is structural issue, and second, if you get the two companies, one is available at 14 times, giving you 14% growth, or one is available at 16 times, which is giving you 30% growth, where do you put your money? So it's about a choice. It's not that IT is bad. IT is a great sector, and they've demonstrated a very good capability. Plus, most IT companies have very high quality of management. So it actually fits into my criteria of that, you need to buy IT because they are great quality of companies, management, manage the cash flows well, have net cash in the balance sheet. So all parameters on the first tick is all been taken care. But what about earning growth? I think that's where you will see a surprises coming in. So I'm not saying IT is it's not a bad buy. It's possibly a buy versus gold or buy versus bank FD. But do you want to allocate your capital within equity to IT or something which is more promising? I'll go towards that.
Right. So, you talk about the first tick and saying that IT is managing over there. Let's talk about the second tick. Say you had invested in NBFC 4 months back and you're suggesting that even now. What gives you the conviction, and despite the recent run-up, these stocks have upside left. This sector has upside left. Can you just tell our viewers what sort of homework they should do before they buy?
Homework in terms of buying the NBFC or buying the overall?
NBFCs despite the run-up.
Again, most things are same, Pankaj. You have to see amendment quality, what they are focusing on. So you take an example of microfinance company focusing on the unbanked sector, unbanked areas, unbanked territories. I think it's a great opportunity. If your quality, so I think 80% focus of mine is quality of management, and the rest remains on the financial ratios and whether it's scalable or not. Everyone knows the microfinance is a scalable opportunity, NBFC is a scalable opportunity. Again, if you tell me that the run-up has happened, it has been decent for last 1 year, almost everything is gone 2.5 times or 3 times from this bottom. But my view is that if you're again buying for 3 months, there may be a correction, there may be a shock because things are moved up. So you have some negative news, you might see some correction. Again, you're buying for 3 to 5 years, this opportunity remains very, very big in this country because as we discussed, only 33% of Indians have the banking facility. So I think there are good amount of opportunity in this sector. And I think I am continue to bullish on the housing as a growth, auto as a growth. So that will actually help these companies to do better.
That was about the sector. So within most of your answers, one thing was the global shocks. Let's talk about probably the Fed rate hike first. Say if it were to happen, are markets prepared?
That's a tough question. But if I look at last 3 shocks or a couple of shocks which we've seen, one is this Pakistan-India, that surgical strike, or we've seen Brexit, which is there recently. What happened to market? Markets have fallen for a day or 2 or 3 days, and then it kind of come back to the normalcy. I think that's the whole advantage which India is right now in this. So India is in really sweet spot. Why this is happening? I'll tell you clearly. One thing is we discuss about that there is no growth in the world. But most important now, which you have to add to this, is the domestic money. So I remember in 2008 when this Lehman crisis happened, the hedge funds were selling big way in India. And you had insurance companies buying from them. I was part of the insurance company, and because they have a lot of ULIP money. This time you have mutual fund doing very well. So if you look at current year, okay, the mutual fund, last year, the FY16, the net flows from FI is 0. And mutual fund put almost $17 billion into the system. So if you have that kind of money coming, $1 billion kind of average in a month, I think that's a very good barometer by which we can say that the financial saving is moving towards the equities, which is very, very underinvested in the last 20-25 years. So you have a really good tool where you can see a monthly inflow coming from mutual fund, and it has been sustainable. Current year also in first 6 months, we've seen almost $4 billion of inflow from mutual fund industry, despite of the index is high. So I think that will continue because we are so underinvested in the equity side. So I'm not worried about any kind of global shock, which may turn into a short-term difficulty. It may turn into a sector difficulty. It may turn into a stock difficulty, but it will not be a macro difficulty for India, because India is going to grow at a pace of 7.5%, by which you'll have few days of correction, and then you can see guys who are not impacted by them, they will strike back fast, and those who are impacted definitely will have impact. So you're seeing that Brexit happening. Some of the IT companies have impact on that. Some of the auto companies have impact on because of that. So they may be impacted on the earnings side, but whole basket will not be impacted.
Right. So, just the point that you made that, whenever we are seeing anything, we're getting money coming in from inflows. Does that, give you a sense that financial institution as a space is also an opportunity in the market? So broking companies, maybe AUMs, we've seen listing of insurance happening. We've seen mergers into insurance happening. Do you think that's a big sector which will emerge?
I'm not too gung-ho about insurance, honestly. Neither a broking company, because broking company is going through a lot of challenging times in terms of spreads coming down, technology evolution, and I think the competition is really hot up. But I think mutual fund is one space which, I don't know, we talk about this channel, but last Diwali, I remember in one panel discussion, I said about a mutual fund. I think one of the big sectors emerging is mutual fund. I think you'll see
right now you don't
tremendous growth of, so you can play through the, different baskets. You can play through the, of course, in different stocks, but you don't have a direct play right now on a mutual fund, which might happen in a couple of years' time. But I think mutual fund as an industry in India will really grow big, because you have two advantages to mutual fund. One, they're very accessible and they have the good geographical distribution. Second, their cost is very low. So what they charge to investors is not as high as other financial instruments. So I think there's opportunity for mutual fund to outgrow the Indian savings market. They can take the big share of the Indian savings market.
But that may be some time away. So till now, for any financial play, NBFCs and rural-facing NBFCs continue to be the best.
Exactly.
Right. Let's talk about a second global shock, which may be the US elections. Do you think it's a very big issue for the Indian market, or it may be very, very sector specific, say whatever the outcome is?
I think, as I told, it immediately will look like a big shock. So I'm not sure whether it's a shock going to be a shock or not. I'm not sure that Trump or Clinton, who is going to take this, it's very difficult to gauge. A lot of people talk about Clinton as taking over, but a few weeks back we were talking about Trump. So really, let's see the election result. It's not easy to kind of predict the result. Whatever the result may be, say scenario A, I think you may see a price coming down for a few days or few weeks, and then you'll see a reallocation of that same money going to a different sector. So if the IT is benefited, people will move from something to IT or vice versa. But you'll not see the Indian market correction will remain for long. That's what my view. So even the elections on the state election side on India, or you see US election, or you see Fed rate hike, I think this all will be temporary and will not take away, because you have a very strong domestic flows. Even some Gura want to sell, or if I want to sell, there's strong domestic inflow, not only on mutual fund side, also on the retail investor, which is coming directly to the market. So you have almost $2 billion of money coming every month to the Indian markets from Indians, which is a big positive. I've never seen in my whole 20 years of career that you have $25 billion of money coming into Indian market by Indian investors. So that's started. So I think that will kind of take care of it because of the underinvestment.
And the point that you made, markets may shock or just get a shock, that can be just a very limited risky capital which may come out.
Very temporary. It's a very temporary. So any shock which is going to come, which is what we are talking about, whether it's a UP election or any other election results, or Fed hike. Again, I'm of the opinion that Fed may hike once and then again kind of stay put for a long period of time, because there's actually a shortage of growth everywhere, including the US. So there's going to be a one-time event, and that one-time event can last for a few days or few weeks.
Right. Just to end this, can you just tell our viewers that any such opportunity, as an insurance player, you've been looking at big ideas for 10 years, you don't care about budget, you had told me once, it really doesn't matter towards your thinking. Can you just tell us that how things work, and if there is a big global shock and there is an opportunity, how should one look at it?
I think it's clearly, one thing is clear, that investors should have a big equity allocation as part of their portfolio, which unfortunately India don't have. We always glitter towards the gold, and we always kind of go towards the physical property. But I think we need to have a very serious equity allocation in our book, particularly when you have such a good, sweet spot kind of situation for you, and you have such a good government which is doing a tremendous job. I think that's opportunity for India. And once you have this kind of shock, I think most people worry about that market will get another 5% down, but that's opportunity to buy. Now, if you don't understand what to buy, how to buy, I think we have such a lovely mutual funds in India where you can actually kind of pick up a nice fund manager and you can give money to him. And best way to do is SIP and all that we discuss all time about the allocation, asset allocation. But I think it's opportunity. If you ask me, Pankaj, the next 10-year view in India or 5 to 10 years view, I think Nifty can give 15 to 18% CAGR, which many stocks can give much higher than that, some can give lower than that. So there is opportunity in India, whether it's a buy on dip market for next few years, then the sell on rise market.
Right. Just to conclude, just from the answer that you gave, for our viewers, they keep finding ideas from the interaction that we do. The key takeaway this Diwali for any viewer who's trying to find would be that first manage your wealth, get the equity allocation and debt allocation right, and then look at what in equity you want to buy.
I've seen smartest of the people who ultimately end up having a 5% or 10% equity allocation. So my advice to most young people is that you should have at least half of your money into equities, which is very long term. Again, don't try to trade and don't try to get in, get out, and don't try to play technical of the market, but rather than play a long term of the market, and that can actually create a substantial wealth. With this, we have a live proof of US market, we see live proof of European market, we see in China. People have made tremendous wealth when this kind of curve has been positive on a demography, government, governance, and penetration. So India is in that spot where next 10-15 years can be a very good years for the wealth creation, despite we have seen such a rally which you're talking about.
Right. Vikram, thank you so much, and hope you have a great Diwali.
Thank you. Same to you. Thank you so much.